Hey everyone, I'm Matt here with Down to Trade. It's Sunday, January 29th, so welcome to your week in review. There was a lot going on this week with GDP, unemployment, PMI, consumer sentiment, and more. And this week will likely rattle the economic cage as we find out which direction the Fed will look to take the economy with their monetary policy. Today, we'll discuss my prediction for the Fed funds rate hike this Wednesday and how I think the market will likely respond. Plus, in the down to trade room, we closed this week with a 4.9% rate of return in just 4 days. So, without further ado, let's get down to trading. Okay, so looking at this week, we saw inflation adjusted GDP rose by 2.9% in the fourth quarter of 2022, only slightly down from 3.2% in the previous quarter. Although we can gloat about the positive numbers in consumer spending, the GDP still has an overall negative momentum. Anyone paying attention to the recent earnings reports will not be surprised by this. And it only confirms the idea of a slowing economy with a decreased demand. Now, with the Fed rate hikes throughout 2022, inflation has significantly dropped since its high of 9.1 in June. And as we all know, some sectors were hit harder than others who were less sensitive to the rise in interest rates. The most obvious example would be real estate. We've seen an almost 90% decrease in mortgage loans, for instance, and the car industry almost halted altogether. What is likely is that more sensitive sectors are only the first to feel the pain, and others are just lagging behind. Now, there are a lot of analysts out there who are jumping onto the soft landing narrative. They see unemployment was down to 3.5%. I'm not even going to discuss the fact that, according to the US Chamber of Commerce, we have 3 million less workers today than before the pandemic, or the fact that once you have not had a job for a while, you no longer count toward unemployment. But if you consider that real wages, that's wages after being adjusted for inflation, real wages are still down. In other words, wage growth is not keeping up with inflation, and this trend is expected to continue into 2024. We saw the tech sector cut more than 90,000 jobs in 2022. That's more than a 600% increase in job cuts from the previous year. Now, we have heard plans to lay off more employees from companies like Amazon, Microsoft, IBM, Google, and others. And now this trend is bleeding over into other sectors as well, like financial and retail. The unemployment rate is expected to climb to 4.9% this year. All that said, I do believe the Fed, although they were late, they did show resolve by sticking to their guns and holding firm on their tightening policy longer than most of us gave them credit for. Although I would certainly not say we're in for a soft landing, I don't believe the recession that we will be hit by will be as bad as the great financial crisis of 2008. Now, as for this week, the big ticket item that we're all kind of waiting for is the federal funds rate hike on Wednesday. Now, after watching the onslaught of Fed members who seem to jump in front of the cameras as often as I can now, do you remember back in the day when we never really heard from the Fed members? Well, aside from a few of them, it seems most members are pushing for a 25-point rate hike this week. Now, the market seems to be in full agreement with that, with a more than 94% probability of this 25-point hike. So, as for my prediction, it's a no brainer. I think the market's reaction will be twofold. There is no doubt this hike is already priced into the market. However, with the number of trigger happy retail investors trying to call the bottom, I think we will see another short term boom in stock prices. Now, as everybody who trades with me knows, I won't be trading our strategy this coming Wednesday due to the increased implied volatility that'll be present throughout the day. Because as you know, high implied volatility is horrible for sellers of option spreads. That said, let's take a look at what we did last week in the down to trade room. I only traded Monday through Thursday, and per my rules, I was not allowed to take any trades on Friday, although it was tempting. But we were profitable all 4 days. Now, on Monday, there wasn't much going on with news except for a little boost to the tech sector during the pre market. With the mid level volume we were seeing, I waited for a break above the first 1 minute candle before entering with a bull put spread at 944. I got into that spread for 80 cents. Now, 16 minutes later, we exited for 30 cents for a 50-cent premium capture. Now, Tuesday was a little bit tougher as the New York Stock Exchange sustained some kind of glitch in the early minutes of the market. In the trade room, we noticed something was wrong about 30 seconds into the day. Now, after a couple minutes, I did announce that I would not be taking any trade that day unless they fixed the issue. Now, we did finally see that they did fix the issue about 10 minutes into the day. So at 10:02, I entered a bear call spread that went against me pretty much immediately. Minutes later, I did decide to defend against this horrible position with a bull put spread. And after a few more moves, I was not only able to climb out of the hole I had dug, but I was able to turn it into my second best day of the month. Wednesday, we woke up with a significant gap down in the pre-market. I did expect the market to push down toward the 39.40s, so at 9:49, I jumped into a bear call spread for 80 cents. 7 minutes later, I was out for 25 cents. I think everyone in the room was done trading in under 30 minutes that day, which meant we all had to go do something fun for the day. It was just one of our agreements that we had. Thursday, we woke up with a nice gap up. With the significant comeback we saw on Wednesday, I expected a pullback to Wednesday's close in the morning as bulls would look to take profit at market open. I jumped in on a bear call spread at 9:49 for 85 cents and was out for 30 cents at 10:41. The market did eventually touch down on my expected close from Wednesday and went on to form a nice high of day up in the 4060s. Friday, again, I couldn't take any trades on Friday per my rules. And for those of you who don't know, I choose one day every week where I do not take any trades. And this rule came about as a response to a trade weakness I had many, many years ago. Back then, I noticed that I felt, I don't know, anxious or nervous when I wasn't in a trade. In other words, I always felt like I needed to be in a position at all times. And this obviously caused a lot of problems for my trading back then. So I decided to attack this problem by making myself watch the market one day every week without taking any trades. I would actually have to sit on my hands at times. Eventually, I became desensitized to the idea of always being in a trade. And obviously now, all these years later, I can watch weeks worth of trading without a single urge to jump in. But I still maintain the disciplined approach to the problem by staying out one day every week. I'm curious, what do you do to fight against your trading weaknesses? I'd love to hear about them in the comments. It'll help me find new ways to encourage traders who might be looking for ideas. Well, it was a fun week in the room. With only 2 trading days left in January, we're right on track with our expected return for the year. With an 81% win rate so far, I have every reason to believe that we'll get there just like we did in 2022. Anyways, I hope this video was helpful in some ways. Look, if you struggle with making a consistent weekly income in your trading, check out our trade room. With our 1 week free trial, you have nothing to lose. Plus, just for giving us a try, you'll get our SPX guidebook, which outlines all of our moves for this strategy. Think of it like our strategy playbook, and you'll get it free just for checking us out. Not only that, during your free trial, you'll be able to watch all of our session recordings from 2023. When you add up all the perks, it really is a fantastic value. So that's all I have today. Now, if you like this content, please take a second to hit the like button down below. And don't forget to subscribe to the channel if you haven't done so already. Okay, everyone, that's it for me. Take care. Happy trading.